Welcome to another episode of Purchase to Profits. I'm Seth Ferguson. Make sure you hit the subscribe button so you don't miss our daily interviews with successful real estate investors. Our guest today started investing in 2002 and left the corporate world 5 years later to become a full-time investor. He's currently invested in more than 70 opportunities worth more than $1 billion. Jeremy Roll is the president of Roll Investment Group. Jeremy, welcome to Purchase to Profits. It's great to have you on the show.
Thank you. Thanks so much for having me. I really appreciate it.
Yeah, I'm really looking forward to speaking with you. I know you've got a long track record of successfully investing in real estate and other businesses. So I'm hoping myself and our viewers can learn a lot from you.
Yeah, absolutely. Like my goal here is that people benefit from this episode somehow. So that'd be great.
Yeah. So to kick things off, do you want to tell us about your real estate goals right now?
Sure. I would say that, it's always my goal to look for cash flow. I tend to look for kind of low risk, passive, what I call more predictable cash flow. My goal is to go to sleep tonight, wake up tomorrow, and not much has changed because I live off the cash flow, and that's a really critical thing for me. So just high level, that's my goal. Now, I would say that we're recording this in early 2019. My goal is to just be extremely careful because I think we're at the end of a cycle. And so my goal is to not invest in the wrong thing and to make sure that if I'm going to find something right now, it's going to have unique pricing and make sense, because right now I find almost everything doesn't make sense to me anyway, just as from a pricing perspective alone. So my goal is to be really, really careful and to ultimately mostly wait till the downturn while still trying to find some unique opportunities here and there.
Yeah. And you mentioned you're currently living off that passive cash flow. At what point did that happen for you? Was that, when you went full time? Is that when you made the switch?
Yeah. So first of all, I want to be clear that unlike some other people I talk to, which is something I would prefer to do, I did not go down this path starting in 2002 and say, I'm going to, rotate my money from stocks and bonds. And then hopefully in 5 years or 10 years, I didn't have a plan and get out of the corporate. I actually wanted to have the W-2 paycheck and the cash flow. So what ended up happening is I started rotating my money out of stocks and bonds into cash flow in 2002 because of the dot-com crash. I was sick and tired of the volatility and the lack of predictability of the stock market for my long-term retirement. And so that's what attracted me to more like predictable cash flow. And what happened in 2007 is that I rotated all my money at that point into cash flow, and I had enough cash flow to live off of, and I didn't want to leave, but I had a last straw moment with my manager in the corporate world at the time. So I took the risk of leaving at that point. It was June 2017. 2007. And so that's really what happened with me. I want to be clear too that I did not build up, this might be too complicated, but I did not have a whole bunch of stabilized, regular 10% cash flow type of deals at the time. I had a little bit of commercial real estate syndication, some business stuff as well. And the majority of my cash flow at the time, I didn't have enough money accumulated to just say at 10% return off all that equity, I could just get out of the corporate. It wasn't enough. So I ended up with a combination of normal stuff like that, as well as what I call more amortized opportunities, which means that there's no residual at the end, meaning that there's no building left at the end. You get more cash flow up front, but you eventually, it's almost like when you pay down a mortgage for 30 years, there's no payment at the end. I was on the receiving end of that type of thing. And so I had to be very careful when I left the corporate world because if you live off of all that cash flow, there's nothing left at the end. There's no residual. So I eventually kind of diversified out of all that over time. It took about 5 more years, and I got to a much better place. But so that's my long story short, of how that worked.
Yeah. And how did your mindset have to change for you to go from your W-2 job, having that salary, to now being a full-time investor? Did anything change in how you approached or thought about real estate and investing?
I would say, look, my personality has always been low risk, but now that I'm actually dependent on the cash flow, and I have been for a long time, it's even more critical that I'm picky and very careful in choosing what I invest in, which is why I started off saying I'm trying to be careful right now. And so I always have that personality, and that's really helpful. But once you're actually dependent on the cash flow in that way full time, that becomes even more critical. So the one thing I will say is that I become more cognizant over time about every dollar that I have available to me. I have a few startup investments. They're very rare. And if I'm ever considering one, even though there could be a big multiple, what kills me is that if that goes to zero, I've now had the opportunity cost of a specific amount of cash flow for, if I were to invest that properly, for tens of years.
Yeah.
And whether come out of one opportunity, go into another. So I'm really now even more careful with every penny that I put to work.
Yeah, no, that's a really good point. So with you right now, do you have any rituals or routines that you go through, maybe daily or weekly, that helps keep you focused?
I would say that number one is that I always prepare for the next day, the day before. And in fact, to the point where I actually time delay. So I have a follow-up list that I keep for every day. And so let's say that you and I exchange emails today, and I need to follow up with something from you. Like I hope to get a response from you. I'll put a note in my calendar 6 business days later to follow up with you again if I don't hear from you. If that day comes, the day before, I'll see it for the next day in the evening, and I'll actually type out an email following up with you, and I'll time delay it for the next morning, and I'll send it for 9 a.m. your time, whatever time zone you're in. And so that's one thing I do so that I can kind of get ahead. It's almost like you're doing the morning emails the night before, and that allows you to then deal with emails in the morning better, because then you're reacting to some of those replies. It's more efficient, and you're not having to scramble and getting all that out before you start getting on calls. So that's one thing I definitely do. Keeping organized with the follow-ups is absolutely critical. I'm talking about not the way I describe it, but in general. Marking down, look, if I got to follow up with this person, it should be on this day, and having some system that you'll be reminded on that day to do that.
Oh, for sure. And I'm sure, in your network right now, just because you have so many opportunity investments on the go, you have to be extremely organized because you've got all that flow coming in, right?
Yes. And I also have my own private investor group, and I don't want to get into the details of that, but there's a lot of investors there too. And so I have a ton of follow-up items, like a ton.
Yeah. Do you have an executive assistant?
I don't. The closest I've come is I use a scheduling by a company called Schedule One. So then there's Calendly and some other ones that are really well known. Calendly, I think. And I've been using that for years, and that has just saved me a ton of time in the scheduling and stuff. But I don't have an assistant. I'm actually still a one-man show.
Yeah. Do you think it would help your business if you brought somebody on?
I would say that most of the calls I do are myself. And so the issue I had actually was a lot of the scheduling, the times of scheduling, sending someone all the availability. That cut out a lot of it. Once you get rid of all that, there's definitely some stuff I could be doing. But the challenge I've always had, I don't see someone being able to do 30 or 40 hours a week of actually helping me. And so there might be like 10 or 20. And that's why I resisted committing to spending the money on it.
Yeah.
So,
no, I use the Calendly. It's like a tongue twister, Calendly, to book everything. And I found it's been great because it's almost like the person you're speaking with like helps themselves and it's connected with your calendar. So it eliminates 5 back and forth messages when you're setting something up.
I don't know how many meetings I use in a year to say. I'm going to go ahead and guess that there's easily 500 to 1,000 meetings that I book in a year on that system. Yeah. If you start running the numbers on how much time that saves me, especially for the cost, which is it's pretty astonishing. I've actually been using Schedule Once probably for 5 to 7 years. I think it's been a long time.
Yeah. And this is an unsolicited plug for both those services.
Yeah, absolutely. Yeah, no affiliation.
Yeah. So as you were building up your portfolio, did you ever try any strategies that you thought would work out, but ended up falling flat?
I would say that, well, so there's a couple of things coming to mind. First of all, I tend to invest in single family and commercial. And what I've learned over time through literally experience trying is that I prefer commercial for a couple of reasons. One of the most obvious ones is diversification. I love tenant diversification because I try to go on the low risk scale of the spectrum. But what I have found is, and this is a generalization, blanket comment, but I found that as a passive investor, the average commercial real estate operator or sponsor will have more experience and have more of a infrastructure than the average single family investor or operator. There are some large single family operators. There are some very well organized ones and all this, but on average, I found that I've had more luck having a more buttoned up operator when I invest on the commercial side. So that's number one, and that's through pure experience. Yeah. The other thing I was going to say is that I have learned for myself that diversification is just key. And what I've concluded over the years, as a passive investor, I can trade control for diversification. And what that means, though, is I've got to be really, really well diversified. So I pay a lot of attention, and I've learned to, over time, to be diversified across asset classes, geographies, and operators. That's kind of just what I say. And that's something that I've really focused on over time. I'm now hyper diversified. You mentioned I'm in over 70 different LLCs. I've easily been in over 100 over time. It takes a lot of work, but it also creates a ton of peace of mind. And so it's a lot of work, but in my opinion, it's worth it. And you learn over time kind of what that has to look like, how you do it. Another thing you'll learn over time is, what are you comfortable with? So I'll give you an example. In Florida, I'm 100% comfortable investing in a self-storage facility because even if there's a hurricane, the modern ones tend to be built to very high wind standards. The tenants have to keep their own insurance in case there's a flood or any water. And the typical worst damage you have is like an air conditioner. It was either on the base, on the actual road, or at the ceiling, the roof, which is typically not very high. And so, I can deal with that. But would I want to be in a 300 unit apartment building on the water and that was just blindsided by a hurricane? I'm not sure. I'm not saying it's a bad thing or a good thing. I just don't know. So I've learned how to mitigate some of the other types of diversification and what to do and not do based on all that experience too. And that's something I think someone needs to that's a very personal thing that someone has to consider over time for themselves.
Yeah. And you mentioned that yourself as a passive investor, you like to diversify yourself in geography and operators. Do you want to maybe talk about how you even, your thoughts in, do you want to be on opposite sides of the country, or would it just be different MSAs within a state?
Yeah, great question. So just as a starting point, I'm open to investing literally anywhere. Now, what I'll say automatically for myself is that I avoid kind of the higher value, lower cash flow areas because it doesn't really fit with my box. And so California is a great example of that, even though I happen to live here. So that's kind of number one. Number two is it's not a question of East Coast or West Coast for me. It's a question of any markets that make sense. And when I look at a specific market, you're going to look for population growth, strong economy. And I know it sounds kind of like cookie cutter, but it is important. You have to go back and look at the trends and look at all the growth. And actually, you also want to look at whether there's really good diversification of employers. Houston's a great example. 20, 30 years ago, it was very concentrated in oil. Now it's actually pretty diversified. Yeah. It's not perfect, but it's still much better. And so I'll look at all these different factors. And, I have been to 43 states now. I've actually, I think I've traveled in 43. I don't think I've invested in 40, but I'm pretty sure I've traveled to 42 states, most of which has been through looking at real estate deals. And it is amazing, even within the same state, you could drive half an hour away from a location and be somewhere you don't want to invest. And I mean, just from an economic or population growth perspective, just that close by. So you really got to look at the local market and in my opinion, judge that. So there's no real formula I'm following. I'm looking at every deal independently and seeing if it makes sense.
Yeah. And as you're vetting operators, as a successful passive investor, what sort of things are you looking for from that operator? Do you have any criteria they have to fit? Yeah.
So, well, I'm going to get, again, that will depend on the asset class, but I'll give you kind of some general comments. So number one, high level. I'm looking for an operator that is looking to be conservative, use assumptions that are very conservative, looking to underpromise and overdeliver for investors so that they'll probably outperform, and is looking to build long-term relationships somewhat by actually using conservative assumptions, knowing that hopefully they're going to overperform to build those relationships. Trying to avoid operators that are just trying to make the numbers look good in their assumptions to attract investors for the returns. I would say that, it's going to really depend on the asset class.
Yeah.
Do you have any specific asset class in mind?
Well, let's choose a multifamily.
For multifamily, I'm going to look at the expense ratios. I'm going to look at some of the cap rate assumptions, where they think the property is going to be in 10 years. I'm going to look at the revenue increase assumptions, the expense increase assumptions, the actual business plan. I'll give you a great example about the business plan. I'll invest probably up to what I call minor value add, which is maybe an internal rehab of all the units, but not a forced, pushing people out when the lease is up. It's only when they want to come out and the units turn that they'll actually go and rehab it. Well, what assumption are you using in terms of how long is that going to take for all the units to be done? Is it 1 year? Is it 3 years? Is it 4 years? Is it realistic?
Mhm.
And then also, are you assuming some downtime in there for units that are actually offline or not? Because I see it both ways for sure. Some operators don't. And so those are, you can get into a lot more detail, but you got to really get into detail to understand what an operator is thinking, and are they being conservative or not, and how do you analyze that? With apartments, by the way, you're going to want to look at the weather, because in colder weather, in some of the common areas, you're paying for that heat, and that can really add up. As an example, you want to look at the amenities. How much is it going to cost you to maintain a pool versus not have a pool? There's so many different factors. And actually, I want to say one more thing about apartments that I thought I learned recently that is very interesting to me. So Class B, talked to a very experienced operator who is switching away from 1980s, going to mid-1990s construction now. And the reason why they're doing that to maintain Class B into 10 years out is because there's a structural problem with a lot of 1980s build, and that the ceiling is only so high. And you can't hit a 9-foot ceiling. And you can go and do whatever you want to rehab an interior, but if the building isn't 9 feet, you cannot extend the ceiling. So, even looking at those factors within apartments and where the demand's going to be in 5 or 10 years, and does the building today meet that criteria down the road, is important. But I can kind of go on, but there's a lot to look at, obviously.
Yeah, those are some good tips. And I think the general message is, even though you're on the passive side, on the limited partner side, you still have to vet the deal. You still have to know, you have to educate yourself about the market and the underwriting. You can't just go in blind.
Yeah, I agree with you 100%. And I think that, if I had to pick one thing that I think a lot of passive investors, unfortunately, two things that passive investors don't do that I think that they really should. One is background checks on the operators. I just don't hear that being done often. I do it every time. I actually literally just came from running one on an operator right now. And then the other is thinking 10 years out. So if you're like me and you're getting into a 10-year hold a lot of the time, you've got to think about what is happening. So great example is this Class B we just talked about. I think a lot of investors will look at a rehab plan on a 1980s build today and say that looks like a great idea, but they won't be thinking about that fact that 10 years out, there's a lot of millennials and even younger people that be demanding 9-foot ceilings. Does the building conform to that now for them? Yeah. Right? Where is this location? What's this location's economy looking like in 5 or 10 years? Then, not now, because you're locked in with the lack of liquidity situation, which is just typical for these types of opportunities. You've got to think ahead. There's better examples in other asset classes, like where are retail strip centers going to be in 10 years from now? Where are self-driving cars going to be? And how is that going to affect multifamily and all the other asset classes? Where are robots going to be? And how's that going to affect some of the jobs in the area you're looking at that looks okay right now? You really got to think ahead and do a lot of time reading, spend a lot of time reading and anticipating where things are going. And I think a lot of investors look at the snapshot of the business plan today, but don't think ahead.
Yeah, I think that's $1 million tip right there. That's a really good one. So thinking back to all the deals you've participated in, is there one that stands out as a keystone deal?
Yeah, I would say, I've been in a lot of them. I would say that, let me just give a recent example because it'll be easier. So, I focus on cash flow. So this one's going to be more cash flow focused. So I invested in a 2-park mobile home park portfolio in fall of 2017 with the experienced operator. And at the time, I really thought that most mobile home parks were overpriced. But kind of point number one is that it had unique pricing. We had probably 100 basis points or better difference in the cap rate compared to what I thought the real market was. And that made me comfortable even looking at it because mobile home parks have become very pricey in the past few years. So mobile home parks are fantastic for cash flow if they're highly occupied. So we bought this thing at the right price. It had, I'm just going to generalize to make it simple, 200 lots, 20 vacancies. Okay. Operators come in, done a fantastic job. So we got 12% cash flow going in immediately. Okay. Just to give you an idea of where it started with the cap rate and the leverage and everything, which is very hard to find right now. We just got it at a good deal. And then they came in, executed really well. They were very conservative, which we talked about before. I think they projected maybe putting 4 homes into, bringing 4 homes in and selling them and filling those 4 lots in the first year. They actually executed on about 10 in the first year. I think already at 14, we're almost now full. So what is that? And also because they've executed really well and are conservative, because we bought it right, we've now kind of got the perfect storm of, okay, we can go sell it or refinance it at a much higher value. So say we paid about 6.7 for it, it's actually worth about 10.5 now. It's only like a year and a half later. keep in mind that those are huge numbers when you consider the fact that this was just supposed to be a stabilized cash flow play. This is not meant to be an appreciation play. So we're actually about to do a refi after a rent increase that should pull out about 40% of equity to investors and maintain double-digit, about 12% cash flow yield going forward on the initial equity invested, not on the remaining equity. That is a huge win for a cash flow investor. And again, it just comes back to conservative assumptions, overperformance, buying it at the right price.
Yeah. It's like Scotty on Star Trek. He always says it'll take him longer than it actually takes him to fix the Enterprise.
There you go.
Yeah.
There you go. That's hilarious.
So how does the so for you entering into that deal as a limited partner, how does the operator come to you and say, hey, listen, I just acquired this for 100 points under market value. Are you interested in the story about how he acquired the property? What's important to you?
Yeah, well, first thing is that I do a lot of networking and talk to a lot of different operators and investors. So first important thing to me is to understand where the market is, not what they're telling me, because you don't want to necessarily just take the operator's information and assume it's all correct. You want to have your own opinion about where the market is so that you can know whether they're being honest with you and accurate with you. So that's number one. And so that's very, very important. Number two is it's always good to hear how they acquired it, what the story is, what the background is as to why the seller's selling it, was it off market or not. And then I usually, in fact, I did visit that property on site with them in person and spoke to the current managers who they kept. Those managers gave us a tremendous amount of insight, the on-site managers who were residents of the park. And at the time, there was a very long waiting list of people who wanted to move in. Current owners just didn't want to spend the money to bring new homes in. Fantastic opportunity, right? And we proved out, we were taking their word for the demand, but you could take a look at other parks in the surrounding area and try to judge demand. You can also do a sample ad in a local newspaper or online and test, and all these things typically happen. So it's not just about taking the operator's word for it. There's a lot of research you have to do independently, but you want to start by taking all the operator's data, and it's almost like a trust but verify, so to speak. That's kind of how passive investor has to operate. They really should verify, though. I have a feeling a lot of passive investors don't verify.
Yeah. And that's why I like, you've mentioned that a couple times, like the passive investor, even though you're passive, you have to take an active role in vetting the deal.
Yes. Yeah. And I hate this. I talk to a lot of passive investors. I don't think a lot of passive investors do it. And clearly some of the deals will work out, some won't. And the difference is that maybe they could have done a little more work up front to sort that out. There's obviously a lot of situations, nothing's perfectly predictable. I can tell you 1,000 ways the deals can go bad, but try to put yourself on the best starting point if you can.
Yeah, no, absolutely. So, you've had a great career so far investing, and I'm sure you're going to just kill it over the next, 10, 20 years. How has real estate changed your life so far?
Yeah, I cannot stress. So I don't want to sound like an infomercial, okay? I went down the corporate track. I had over 10 years of corporate experience. I got an MBA from the Wharton School. I went through the whole corporate thing, and cash flow just completely changed my life. And most of what I invest in is commercial real estate with diversified tenant-based, low-risk focus, cash flow focused, obviously. And so I cannot stress how much positive change that this real estate has had on my life. It's allowed me to get out of the corporate world. It's given me the flexibility to do what I want. And I happen to love investing, so that really helps. And there's tremendous tax advantages or tax benefits to being even a passive investor, very similar to active, which a lot of people who out there who maybe don't invest in real estate don't understand, but it's pretty big. But bottom line is the cash flows can just completely change my life. We were just talking about this. Unfortunately, I fell over the weekend and broke 2 ribs. If that would have happened, I was working a job, that could be a problem. Now, all it is like the biggest inconvenience is that I may have to reschedule some meetings that I could just choose to reschedule. So I will tell you a quick story, which is a true story. In 2011, I had a son who was a year old who had a really bad virus and got hit very hard, had to have 2 or 3 surgeries, was in the ICU for 2 weeks, was in the hospital for 2 months, and I had to go back for another surgery after that. I can't imagine. I was in the hospital for 2 months, either my wife or I, every single day or night, 24 hours a day. I don't know what would have happened if I was working a job and not have the continuity of being able to like work it properly the whole time. And so, I mean, that just, and so at the time I just canceled some meetings and did what I had to do, had the cash flow coming in. So look, it takes a long time to build up the cash flow, but whoever is listening who's considering it, it is just well worth it. It really just changes everything.
Yeah. And I think that just your example, with your family and taking that time, that's why we do it. Like, that's why we invest in real estate and businesses to have that time freedom with the people who are important.
Yes. I work from home and I see my kids every day, 2:33 when they come home, something I never was able to do or could do in the corporate world. At least not by choice, meaning I'm told whether I can work from home or not. Right. So they're just an endless amount of benefits, and really it's cash flow that just changed. Ironically, I went through all these years of getting, the undergrad, the MBA from really good school, going through all this corporate world, trying to, climb the ladder. And ultimately the cash flow was the best option for me after all of that.
Yeah. No, great opportunities. Well, where can people find you if they're looking for some more information about, what you're doing?
Sure. Yeah. Best way is to contact me directly. I'm happy to talk to anybody, help anybody any way that I can. So my email is jroll, which is JROLL at Roll Investments, ROLL Investments with an S, so it's plural.com. So jroll at rollinvestments.com.
Oh, that's great. Well, Jeremy, just want to say thanks so much for taking the time, especially with the 2 broken ribs. Really appreciate it.
No problem. I'm totally fine sitting. It just asked me to get out of this chair now, and that could be a whole different issue.
Yeah,
so.
we'll cut to make sure nobody has to see that. That's great. Well, thanks once again. And to you, our viewers, I wish you well in your journey from purchase to profits. See you next time.